So how do you make sense of a stock that has, rallied a staggering 637% over the past year?
I mean, that number alone is just insane.
Right, 637%. But here is the catch. It's currently flashing short-term sell signals on the charts, but then you have Wall Street analysts literally pounding the table, calling it a strong buy.
Yeah, they're saying it's drastically undervalued.
Exactly. It's a total paradox. And that is exactly what we're unpacking today. We are looking at Applied Digital Corp, ticker symbol APLD.
It's definitely one of the most polarizing setups out there right now.
Oh, absolutely. So today is April 16th, 2026, and the data surrounding this company is just wildly polarized. We've got a mountain of source material today: financials, order flow, technical indicators, and analyst notes.
And we are going to tear it all down to understand what the market is actually pricing in here.
Yes, we are. But before we dive into all of that, you know the drill. Please like this video, subscribe to our YouTube channel, and it is strictly compulsory that you leave your feedback in the comments section today. We need to know where you stand on this wild stock.
Because people definitely have strong opinions on this one.
They really do. And just to be crystal clear up front, we are exploring the mechanics of this trade and analyzing the data entirely for your education. This is just a natural debate of the source material. Absolutely no financial advice is being given here.
Right. Definitely no financial advice. But the divergence on APLD right now is just one of the most extreme setups in the market.
Extreme is a good word for it.
You have this incredibly aggressive tug of war between the reality of the company's current balance sheet and the institutional projections for its future capacity.
So the current price action is effectively a real-time negotiation between those two extremes.
Yeah, exactly.
Okay, let's unpack this. Because to understand the chaotic price action right now, we really have to look at what triggered it. Applied Digital just underwent a massive identity crisis.
Oh, a total 180.
Right. They did not start as a darling of the AI infrastructure world. They actually began as a crypto hosting firm.
Yeah, they were building these massive data centers specifically to house Bitcoin mining rigs.
But recently they recognized the saturation in that space, saw the explosion in generative AI, and executed a hard pivot. They are attempting to transition into this AI high-performance computing giant.
And that pivot is really the engine driving this entire valuation debate. I mean, the market loves the narrative of an AI infrastructure play, right?
Who doesn't right now?
Exactly.
Yeah.
But retrofitting a crypto facility for AI, or even building a new one from scratch, it requires an entirely different standard of engineering.
Oh, completely. You can't just swap out the machines.
No, not at all. Crypto mining operations, they can tolerate variable power, rudimentary cooling. If a Bitcoin miner goes offline for an hour, it's just a minor inconvenience.
Just a little blip.
Right. But AI training clusters, particularly those utilizing thousands of H100 or next generation GPUs, they require 100% uptime, massive grid stability.
And all that advanced liquid cooling infrastructure, too.
Yeah, exactly. You cannot just swap out a crypto ASIC for an AI server rack. It requires completely tearing out the guts of the operation and rebuilding it.
Which obviously brings a breathtaking amount of CapEx into the picture. I mean, let's look at their Q3 2026 financials, because this is where the narrative really hits the spreadsheet.
Yeah, the numbers are fascinating.
They are. The top-line growth is undeniably explosive. Total revenue hit $126.6 million.
Wow.
Right? That is a 139% year-over-year jump. I mean, if you stop reading the earnings report right there, you'd assume they're just printing money.
Sure, but the cost of that top-line growth is severe.
Yeah, the bottom line is a bit rough.
A bit rough is an understatement. When you factor in the depreciation of the old crypto assets and the massive capital expenditure required for that AI retrofit, they posted a GAAP net loss of negative $100.9 million.
Ouch.
Yeah, that is a 36-cent loss per share. They are burning a tremendous amount of capital to facilitate this transition.
I am going to push back on the severity of that GAAP loss, though, because the bulls are isolating a very specific silver lining in this earnings report.
Okay, what are they looking at?
Well, if you look at their adjusted EPS, they actually posted a positive 9 cents.
Oh, right, the adjusted numbers.
Yeah, and that completely crushed the street estimates, which were projecting a 17-cent loss. Plus, they generated a trailing 12-month EBITDA of $25.8 million.
Okay. Right.
Let me just say, if we strip away the heavy accounting burdens and those one-time depreciation hits from, abandoning the crypto model, the core operations of leasing compute power are actually churning out value. Doesn't that adjusted beat prove the operational efficiency of the new model is working?
Well, I mean, it proves the unit economics of AI hosting are viable, yes.
Right.
The margins on those specific leases are definitely healthy.
Right.
But as an analyst, adjusting out the heavy accounting burdens doesn't make the actual debt disappear from reality.
That's fair. The debt is very real.
The balance sheet carries immense weight.
Well,
APLD has $1.87 billion in total assets, but that is heavily financed by $1.24 billion in total liabilities.
leaving them with a debt-to-equity ratio of 168.1%. So for every dollar of equity the shareholders actually own, the company is saddled with over $1.60 of debt to its creditors.
And the composition of that debt is really critical here. They recently priced $2.15 billion in senior secured notes.
That is a staggering amount of money.
It is. And they're raising this mountain of capital for one specific reason, to fund the construction of their massive new AI campus, which they're calling Polaris Forge 2.
Right, the new mega campus.
Yeah. But senior secured notes mean the creditors are the very front of the line. If this expansion fails, those bondholders have a claim on the physical assets of the company before the equity shareholders ever see a single dime.
You know, it's literally like maxing out every credit card you have to build the world's biggest casino.
That's a great way to put it.
If the high rollers show up, you look like a genius, right? The revenue pours in.
Sure.
But if construction is delayed even a little bit, you're bankrupt.
That is the exact binary outcome the market is trying to place in today. Investors are constantly recalibrating the probability of that facility being completed on time, under budget, and fully leased.
And that uncertainty is the direct mechanism driving the current technical breakdown on the chart.
Absolutely.
So let's transition to that price action. APLD closed today at $30.09, which is down 2.34% on the session.
Yeah, a bit of a red day.
If you zoom out to the trailing 12 months, you still see that staggering 637% gain. But zooming in paints a much darker picture. It's trading roughly 29% below its 52-week high of $42.27.
Right. It's definitely in a cooling phase.
It had this meteoric, narrative-driven rise, and now the momentum is completely bleeding out.
Well, the technical indicators are flashing a pretty complex standoff right now. If you look at the relative strength index, the 14-day RSI, it's sitting at a dead neutral 49.06.
So we basically have a total psychological stalemate.
Exactly.
Yeah.
It's not overbought enough to trigger profit-taking, but it's not oversold enough to trigger value buying.
So retail and institutions are just staring at each other.
Pretty much. But the momentum beneath that stalemate is definitely rolling over. I mean, the MACD is currently at negative 0.85.
Oh, wow.
Yeah, the short-term moving average has crossed below the long-term moving average, actively flashing a sell signal. The initial euphoria of the AI pivot has faded, and the market has entered this prove-it phase.
Right, show us the results.
Exactly. And this is most evident when you look at the moving averages. The 50-day simple moving average is sitting at $29.13.
With the current price at 30.09, it is dangerously close to testing that 50-day line.
Very close.
And algorithmic traders and momentum funds, they use that 50-day line as a strict threshold. If the price closes below 29.13, it signals that the medium-term trend has officially broken, which often triggers those automated selling programs.
Right. The risk of a cascading sell-off is really high if it breaks that level, because the next major structural floor, the 200-day simple moving average, is all the way down at $24.60.
That is a massive drop.
It is. Now, the 200-day represents the macro long-term trend, which is still technically bullish, but the air pocket between the 50-day at 29.13 and the 200-day at 24.60 means if short-term support fails, the price could drop violently before ever finding buyers.
So what are the specific levels people need to watch?
Well, looking at historical volume nodes, the critical support floors to watch this week are 28.65 and 27.79. On the upside, it faces dense resistance at 31.35 and 38.26.
Okay.
And notably, a specific sell signal was issued from a pivot top just 2 days ago, on April 14th, confirming that downward pressure.
Okay, so we have technical screaming caution in the short term, algorithmic sell signals looming just below the current price, and this massive debt load. Yet the order flow data shows a mild bullish bias among retail traders.
Yeah, retail's still stepping in.
They are actively trying to buy this dip. They're convinced it's just a temporary pullback on the way back to $42. But here's where it gets really interesting.
Okay, lay it on me.
The short interest is sitting at 29.83%.
Wow, that is huge.
Nearly a third, the entire tradable float, has been borrowed and sold by funds, actively betting the stock will collapse. Who is driving this bus right now?
Well, that level of short interest is a massive structural vulnerability for the bears. When nearly 30% of a company's shares are sold short, the trade becomes incredibly crowded.
Right.
If Applied Digital releases a positive catalyst, say, an announcement that Polaris Forge 2 is ahead of schedule, or, they sign a massive new hyperscaler lease, the stock price will naturally spike.
Oh, and then the panic sets in.
Exactly. That initial spike forces those short sellers into a margin crisis. They have to buy shares on the open market at whatever price is available just to cover their losing positions.
And that forced buying drives the price even higher.
Yes, triggering more margin calls for other short sellers, creating this violent, self-feeding upward spiral.
So retail is buying the dip. Almost 30% of the float is heavily shorted by funds anticipating a debt crisis, and that collision creates a complete tinderbox.
Total powder keg.
Which forces us to answer the ultimate question. Is this stock genuinely undervalued at $30, or is it a classic value trap waiting to crush unsuspecting retail traders?
Well, the institutional analyst community has planted their flag firmly in the undervalued camp.
Really? Still?
Oh, yeah. Despite the deteriorating short-term technicals and the massive short interest, Wall Street maintains an overwhelming strong buy consensus. The average analyst price target is $50.09.
That implies over a 66% upside from today's close.
Exactly. And the highest target on the street is a staggering $97.
A $97 price target on a stock trading at 30 while holding over $1 billion in debt. I have to play devil's advocate here and challenge that valuation.
Go for it.
I am looking at Morningstar's fundamental breakdown, and Applied Digital currently trades at a price-to-sales ratio of 22.7x.
Yeah, it's rich.
You are paying nearly $23 for every single dollar of revenue the company generates today. So what does this all mean? How can any analyst look at a 22x sales multiple on a company with a negative GAAP net income and confidently declare it undervalued?
Because the analysts are not valuing the company based on its current $126 million in revenue.
Okay, then what are they looking at?
They are modeling the valuation entirely on the future gigawatt capacity of its data centers. The analysts issuing those $50 and $97 targets, they're calculating the forward revenue multiples based on the $2.15 billion Polaris Forge 2 campus being fully operational.
I see.
In their models, once that facility is energized and leased to AI hyperscalers, the revenue scales exponentially, while the fixed costs remain relatively flat.
So the multiple shrinks.
Exactly. They are arguing that a 22x sales multiple today will compress into a very reasonable 3x or 4x forward sales multiple by 2028.
But they are essentially pricing in a perfect future that hasn't even been built yet. They are assuming flawless execution on the construction, flawless integration of the liquid cooling systems, and flawless tenant acquisition.
Yep.
If that future hits even a minor speed bump, the multiple contraction is going to be brutal.
And what's fascinating here is that the volatility profile of the stock already reflects that immense risk. APLD carries a beta of 5.76.
That's wild. It moves nearly 6 times as violently as the broader S&P 500.
Exactly. It also experiences an 8.8% average weekly volatility.
Yeah.
The price action is violent because the market is constantly pricing and repricing the probability of default versus the probability of a monopoly.
Which makes it incredibly dangerous for the average investor.
Oh, this environment is highly predatory toward retail traders.
Yeah.
Algorithms will intentionally hunt for liquidity in a high beta stock like this, driving the price down to trigger retail stop losses or driving it up to trigger FOMO buying, only to reverse the trend minutes later.
Right. And beyond the sheer market mechanics and the volatility, there is a glaring fundamental risk in their business model that we need to highlight too.
Customer concentration.
Yes. The customer concentration is a massive single point of failure.
It really is. Applied Digital relies entirely on a handful of massive clients, primarily companies like CoreWeave, to generate the bulk of their revenue.
Right. And if CoreWeave decides to, build their own proprietary data centers, or if they negotiate a cheaper lease with a competitor.
Applied Digital doesn't have a diversified base of 10,000 small businesses to absorb that shock. The loss of a single major hyperscaler lease would fundamentally break their ability to service that $1.24 billion debt load.
Okay, so synthesizing everything we have covered today, the transition from crypto to AI, the 139% revenue growth fighting against the deep GAAP losses, the $2.15 billion in new debt, the technical sell signals hovering right above key support, and a massive 30% short interest fighting against a $50 analyst target. Let's model the outcomes.
Yeah.
Lay out the ultimate bull and bear cases for the listener to watch for. Let's start with the bull case.
Okay, so the bull case, the
Mm.
recovery scenario, it hinges entirely on operational execution. In this scenario, Applied Digital continues to post adjusted EPS beats, proving the unit economics of their AI transition.
Which they've started doing.
Right. But more importantly, they hit every construction milestone for Polaris Forge 2 without drawing down any further high-interest debt.
And the hyperscale leases hold firm.
Yes. As these milestones are hit, the market begins to validate the forward valuation models. And remember that 30% short interest.
Oh yeah, the tinderbox.
The first major positive earnings surprise acts as the spark. Short sellers capitulate, the squeeze mechanics take over, and the stock rapidly reclaims its 52-week high, pushing aggressively toward that $50 institutional target.
That would be the ultimate validation of the pivot. But obviously, if the execution slips, the bear case takes over.
And the bear case is basically a liquidity death spiral. Supply chain bottlenecks delay the transformers or the liquid cooling units needed for the new campus.
So construction halts.
Yeah, the facility sits half-finished, while the interest payments on the $1.2 billion debt load continue to drain their cash reserves.
That sounds like a nightmare.
It is. The market senses the liquidity crunch and begins dumping shares. The stock breaks below that critical 28.65 technical support floor we talked about.
And once that level fails...
Institutional stop losses trigger, algorithmic selling accelerates, and the stock flushes violently downward toward its 200-day moving average at 24.60. And if they're forced to issue new equity at those depressed prices just to keep the lights on, the dilution destroys shareholder value, and the stock gets trapped in a long-term downtrend.
Wow. So it entirely comes down to a race between finishing the construction and the debt maturing. Based on the data in front of us today, how do we grade the short-term versus the long-term outlook?
Well, over the next few weeks, the short-term outlook is strictly neutral to weak. The momentum is clearly stalled. The MACD crossover from April 14 is actively applying downward pressure, and the price is dangerously close to slipping below the 50-day moving average.
So that 28.65 support level is really the absolute line in the sand to watch this week.
Yes. The technical structure suggests vulnerability until proven otherwise.
But the long-term outlook, the view held by the analysts, is operating on a completely different timeline.
Right. The long-term macro perspective remains strongly bullish, provided you believe in the foundational premise of the AI revolution.
Which most of Wall Street does.
Exactly. If artificial intelligence requires a massive physical expansion of specialized compute infrastructure, well, someone has to build and manage the real estate. If Applied Digital successfully completes their expansion, they will own some of the most valuable, high-demand infrastructure on the planet.
It really is the ultimate contradiction in the market right now. You have a company burning staggering amounts of cash to build the infrastructure of the future, caught in a very real, very threatening technical downtrend today, yet backed by institutional price targets predicting explosive growth.
Yeah, it's wild.
We've explored the aggressive debt strategy, the fundamental risks of customer concentration, and the mechanics of the current order flow standoff. But I think this raises a bigger point.
This raises an important question, actually, when you step back from the daily charts. The AI revolution is constrained entirely by physics. Power grids, cooling systems, and physical real estate.
Right. It's not just software in the cloud. There are actual physical buildings required.
Exactly. And the companies attempting to solve that bottleneck are taking on historic levels of leverage to do so. So are companies like Applied Digital aggressively laying the concrete foundation for the next great tech monopoly? Or are they simply taking on catastrophic debt to build the world's most expensive, highly specialized empty warehouses?
That is the ultimate cliffhanger you have to evaluate. Are we looking at the indispensable infrastructure of the next decade or a multi-billion-dollar miscalculation?
It's a tough call.
I really want you to mull that over. Look at the balance sheet, weigh the technical weakness against the macro narrative, and decide where you stand on APLD. And don't forget to let us know in the comments. We will see you next time for another deep dive into the data.